Hello, in this video we'll learn about the monetary policy and the monetary policy tools that are present in the Indian economy. So before understanding the monetary policy, we'll understand how monetary policy is linked with the inflation. So we all know that if price increases according to the demand, inflation starts in the Indian economy. So for inflation, the government has already put this band as 4 plus minus 2% with consultation with RBI. So, for keeping this inflation in control within this band, on basis of consumer price index, that is the retail inflation we take in picture in India now. So, so inflation does not go less than this band and not more than this band. So we have a concept called repo rate. So repo rate is nothing but it is a kind of a policy rate which is used by RBI to combat inflation. So about this we will learn in the next slide also what is repo rate. So for now you just understand that with the help of this repo rate, RBI controls the band of inflation, that is 4 plus minus 2%. So inflation cannot go beyond 6% and cannot go less than 2%, 4 plus minus 2%. So now the monetary policy is nothing but it's a process by which monetary authority of a country, for example RBI, in our country the monetary authority is RBI, which controls the credit creation, that is the money supply in the economy. So it basically works on the price stability of the mechanism. Price stability is nothing but it is the inflation. To control this inflation, the price stability, this monetary policy is used. So before 2015, what was the scene? That this particular repo rate that were used to control, combat the inflation was directly used by the RBI governor. But now after 2015, there was a monetary policy committee in September 2016 was made, which is comprised of 6 members, 3 members from RBI, in which RBI governor and deputy governors are there, and 3 members from government side, in which eminent persons who have good knowledge of economics or finance are taken. So total 6 members, 2 members from each, and this particular monetary policy committee helps in price stability as well as growth, job creation, and everything's on a larger picture. Because in UPSC we learn about the macroeconomics, that is related with growth and development, employment, unemployment, every scene on the larger picture. So in prelims also we have a lot of questions generally asked from this topic, and in mains also we have generally a lot of questions. We'll see in the last slides about the PYQs, previous year questions. So moving on the next slide, we see that there are two types of monetary policy. What are the two types? The first one is quantitative and the other is qualitative. Quantitative is controlling the volume of loans for the entire economy, that is of macroeconomics, a larger picture. And qualitative is generally dedicated to a particular sector of economy, distribution of loan, not volume of loan. So there is a difference between these two. So we will start learning about them one by one as we go for quantitative instrument tools for monetary policy. That is the first one, that is a quantitative instrument, that is the general or indirect tools that are used for the macroeconomics, for the larger economy. So these are the 9 tools: repo rate, reverse repo rate, LAF, MSF, bank rate. Like these we will learn one by one, and we'll take on these tools to understand how these are tools are affecting the helping the combating the inflation. So the first we will learn about the repo rate and the reverse repo rate. So repo rate is very important because this is called a policy rate, and this is one of the major tool by which RBI controls the inflation. So uh, what is the difference between repo rate and reverse repo rate? We will learn about. So repo rate is nothing but it is a kind of a repurchase agreement between the RBI and the banks. That banks, scheduled commercial banks like SBI or some non-scheduled commercial banks also can happen. You can say clients, RBI and its clients. So interest rate at which RBI lends its short-term loans to its client, keeping their government securities collateral. So these banks will give their government securities to RBI, in which return RBI will give them money. So if the clients needs money, they can get it from RBI by keeping their government securities to the RBI. And after the fortnight, this usually happens every fortnight. So after the fortnight, what will happen? The repurchase agreement will happen, in which banks will again purchase those government securities by paying interest amount on that. So this is kind of a thing which is done in repo rate. So what is reverse repo rate now? So reverse repo rate is nothing but just the opposite, in which the RBI will keep the government securities. RBI will keep the government securities with the clients, and clients will park their excess money. Suppose there is excess money with these banks, SBI and all. So what will do? They will park their money to the RBI, and RBI will give their uh, government securities, which RBI have to repurchase it after the fortnight. So this is just the opposite of the repo rate. The one thing you have to remember in this repo rate and reverse repo rate, banks cannot place their SLR quota securities for borrowing. Why? Because SLR quota securities, we learn in next slide that it is just not the cash, but in SLR, it is called a statutory liquidated ratio, in which gold is also kept. So for this SLR government securities and everything, banks cannot place their SLR quota securities for this borrowing of repo rate. For example, when banks will give their government securities to RBI, they cannot place their SLR securities. They can place other securities apart from that SLR. So this is the mechanism similar to repo. RBI gives it government securities quality. This is the reverse repo rate we just discussed. And what is the generally this repo rate is called the policy rate to control inflation, that we already talked about. This is the main thing. And what is the reverse repo rate formula? If suppose repo rate is 4%, then reverse repo rate will be 4 minus 0.65%. This is a general formula used for calculation. And this 4% repo rate is not fixed. It can be changed. It can be changed, and RBI generally changes it. It's always in current affairs, in news, in prelims questions, everywhere. It is like that. The RBI changes its repo rate to fight with inflation. It increases generally its repo rate to fight the inflation. It decreases its repo rate to combat deflation. So like that things arises. So we'll learn about these things in the next slide. So next one is again liquidity adjustment facility, but it is on the basis of RBI's discretion. So earlier we saw that repo rate and reverse repo rate, that was on the basis of the bank's discretion. If bank's client wanted, they can do it. But if RBI wants that I have to do this point of time, if there is excess money in the economy, I have to suck the liquidity. I have to pass the liquidity like that. It can also do these operation liquidity adjustment facility, which are generally termed as long-term repo operations and targeted long-term repo operations. What is this? After Corona, generally reverse repo rate and repo rate, what we saw that it is happening every fortnight, on daily on fortnight basis. But this long-term repo operations and targeted long-term repo operations are for a longer term, more than a fortnight. That you can see here, it is for 3-year loans. The function is same, but it is for a long-term duration. That is the major difference between the uh, reverse repo rate that also comes under liquidity adjustment facility, and these long-term repo operations also comes. But this is generally nowadays RBI is using these kind of things. So the next tool is the reserve requirement tool, and this is also one of the important tool because in this CRR and SLR will come, and this CRR is cash reserve ratio, and this SLR is called statutory liquidity ratio. So CRR is nothing but bank will keep this much deposit with themselves, with with RBI, and RBI doesn't pay interest back on this. So for example, there is a bank SBI, it will keep certain amount of its value. There is anti-TL concept. You must have known in economy that net demand time liabilities. The liabilities on net demand time liability, demand deposits of the bank, the time deposits of the bank, that is covered in the previous chapters of economy. So for particular, there is a bank, it has 100 crores NDTL. So there is exact 0.25% of that NDTL. That particular amount has to be kept with RBI. That particular cash has to be kept with RBI, and that is called cash reserve ratio. And similarly, SLR is also, bank must keep this much deposit in liquid assets. So why there is a statutory liquidity? Liquidity is added because if government securities are kept, treasury bills are kept. For example, golds are kept. So they are much more uh, liquidity in terms of uh, when we compare with other things. So bank must keep these much deposits in liquid assets such as cash, gold, treasury bill, state development loan bonds notified by RBI. And this security we were talking about in the previous slide, that in the repo rate, while having an agreement, when a bank client is having an agreement with the RBI, it cannot place their SLR quota securities, government securities. So this was the thing that I was pointing. So there is some difference between CRR and SLR, that banks earns no profit on CRR, but here some profit is involved. CRR are mandated under RBI Act 1934 and SLR are mandated in Banking Regulation Act. So this is the major difference. This was after the independence. There is no minimum or maximum limit on CRR. Generally it is 4%, and it can't SLR, this can't be more than 40%. It's generally 18%. If I'm correct, it is 18%, it is 4%. All bank must keep CRR, all bank must keep SLR. So these are the general differences, and this is one of the important tool, important monetary policy tool to combat inflation and deflation in the Indian economy. Earlier, uh, these tools were used also, but now the RBI is using just repo rate to fight with inflation in the Indian economy. The next one is MSF. These are the tools, these are the interest rate at which RBI lends short-term loans to scheduled commercial banks and regional rural banks with their SLR quota, government security as collateral. So now there's much easier side. First, we understood that SLR quota government securities cannot be kept, cannot be traded in terms of repo rate. So now this is another thing. When bank needs money, especially with their SLR quota securities uh, as collateral. They can also give these securities as collateral and take the money from the RBI. So for that, RBI has created, for that Monetary Policy Committee has created a tool that is called marginal standing facility, which is a formula of having repo rate plus 0.25%. For suppose the repo rate is 4%, then it will 4.25%, the value of MSF. So the next one is standing deposit facility. What is this? So Urjit Patel committee, he was the RBI governor, he suggested that there should be a system in RBI does not give any collaterals. For example, um, in this particular monetary policy tool, client can park their extra money in RBI. So if the bank will park the extra money to the RBI, the RBI have to pay them interest, but RBI does not give any collateral for this. Earlier, we were seeing that in the case of repo rate or MSF, there was a collateral involved. MSF, there was a SLR. So even SLR quota securities were involved as collateral. In repo rate, also the government securities were collateral. But in this standing deposit facility, there is no collateral at all required. So this is also one of the important tools. The next one is open market operation. This is one of the important tools, because here what happens, that sale and purchase of government securities. For example, suppose in Indian economy there is too much of cash. So if there is too much of cash, there will be more money supply in the economy. So to suck this money supply, what RBI will do, RBI will sell its government securities. If it sell its government securities, whole money will be injected to the RBI, and the total money supply in the economy will be reducted. So this is a kind of a process in which sell and buy of government securities by RBI is done in open market. That is the secondary bond debt market. Uh, so this can be done to inject suck liquidity, to also provide liquidity. If RBI buys the securities, then it provides liquidity. If it sells the securities, sucks the liquidity. So for that, RBI does it in eKuber platform. There is a eKuber platform on which RBI does this. On the same basis, market stabilization scheme is there, that is called sterilization process. This is also one of the important monetary policy tool, and it also operates on the same basis on which open market operation buying and selling of government securities by RBI is done to suck the liquidity or to inject the liquidity. But one difference is there from the open market operation. This market stabilization scheme, this is generally done when in Indian economy, in forex market, more dollars have been brought. So if more dollars have been brought in forex market, forex reserves, what will happen? That Indian liquidity will also, the Indian rupees, the rupee of Indian rupee will also get accumulated in the economy, and the liquidity will increase. So for that, dollars will rupee also get accumulated in Indian economy. There should be a system to control the inflation. So to control that particular inflation, this tool was introduced by RBI to issue government treasury bills and medium duration dated securities for purpose of liquidity observation, and the rest of the things works on the same basis of open market operation. In the open market operation, we already saw that if there is too much money supply in the economy, the RBI will sell its government securities and try to uh, take all the cash, all the liquidity from the economy. In this way, it can fight with inflation. It can reduce inflation in the Indian economy. Same principle, market stabilization scheme will also work. So in this slide, we'll learn about the how different type of tools were used in Indian economy to combat inflation. So before 1991, there was CRR and SLR that we talked about. These were the tools that were basically used for combating the inflation. After 1991 till 2000, the main tools were OMO, the buying and selling of government securities by RBI to combat the inflation, to suck the liquidity and to inject the liquidity. After 2000, what happened? The major tool was monetary policy. Major tool of monetary policy was reverse rate in addition to OMO. But generally, reverse repo rate and repo rate are used. The policy rate are used till now to as an important monetary policy tool and to combat the inflation. Also, monetary policy can be termed as expansionary or contractionary. In expansionary, what happens that uh, if we use this expansionary monetary policy tool, we can use various tools, OMO, uh, CRR, SLR, or even repo rate to increase the total money supply. That is called expanding the money supply, the expansionary tool. And also the opposite is contractionary. What is that? Just opposite, to reduce the money supply in the economy, we use contractionary tool. So we have talked about the quantitative tools for monetary policy. Now we'll talk about the qualitative instrument that will not hamper the particular economy, but they will hamper just a particular sector of economy, not the whole economy, as it was done in quantitative tools, the CRR, SLR, OMO, and everything which we learned about in previous slide. So these are nothing but either selective or direct tools which affect the particular sector of the economy. And the first one is model suasion, which is nothing but RBI having an informal meeting with its client to finally process the terms in a way so that it can have a control of the inflation. So it can have an informal meeting with its client, that is called applies persuasion, model suasion. The next one is direct action. In this model suasion, the RBI cannot use any punitive measures to have that control, but in direct action it can punish banks. It can use its punitive measures to punish banks who doesn't comply with RBI rules, who violates the Banking Regulation Act or some RBI Act or Payment and Settlement Acts, which are very necessary to function in the economy. The next one is margin requirement, loan to value. That was very important qualitative tool in which RBI uses a system in which it gives the a kind of a margin to the banks. For example, when RBI gives loan to the banks have to surrender a collateral as a government security. For that amount of collateral, X% of that collateral are misused. So RBI can control that X% of the collateral to curb the demand and supply in the economy. So it can use, RBI can use that X% of the collateral to have a better control on the demand and supply side of the economy. So this concept was used, loan to value. The next one is selective credit control. So selective credit control is nothing but it has the two types: credit rationing and consumer credit control. This consumer credit control is a positive thing in which, suppose there is a recession, and in that recession the particular person or bank is not able to uh, give the particular interest on the loan. So RBI can have cut down the down down payment or EMI on that particular thing. That comes under consumer credit control. That is in a positive direction. The next one is restrictive direction. That is credit rationing system. It is also comes under selective credit control, in which RBI suppose it gives loans to various department, various sectors. So particular X sector, it will restrict to not giving that particular sector, not crediting that particular sector. That is called credit rationing system. So these are all the tools, the qualitative instrument tools, which are not at all very important in UPSC, but the quantitative tools are very much important, which we talked in the previous slide. Especially repo rate and open market operations are very important. So here we will conclude what we have learned in this whole video about the monetary policy and the monetary policy tools. That inflation is basically caused by two factors. We all know that this is a demand side factor, that is demand pull inflation, sorry, and the supply side factor, that is the cost push inflation. So RBI's monetary policy controls only control the demand pull inflation, this one, and it doesn't control this supply side factors. For example, supply side factors, we already know that in the COVID time, in the Corona time, this supply side was hampered. In the Ukraine war, Russia-Ukraine war, this particular supply side factor, the crude oil prices got high. So these are the supply side factors which are not controlled by monetary policy committee. So what should be done? So monetary policy must be complemented with a robust fiscal policy to galvanize the economic growth and check inflation. So the tools are generally very well. The quantitative tools, the qualitative tools are very much worth. They control the inflation, but there are some drawbacks on the supply side factors. So if they can also be controlled, it would be great. So here we're talking about the supply side factors. So in April 2022, at this particular time, what happened? The Russia-Ukraine war happened just after the COVID wave stopped. So Russia-Ukraine crisis happened, and what happened? That the oil prices went high, and everything prices, commodity prices went high. That was supply side, not demand side. So as we already learned in previous slide, that monetary policy tools generally combat the inflation on demand side, but not on supply side factors of inflation. So in this graph, we'll see about the inflation and repo rate, the relationship between inflation and repo rate. So as you can see in this graph, in February 2022, the inflation was 6 here, and the repo rate was only 4%. So when it started, due to this crisis, the inflation went on rising 7.79 to 7, like this. Repo rate was not increased, because if it happens for consecutive 3 quarters, then only the RBI generally increases this repo rate. So once it got increased to 7, and we also already knew that the band is 4 plus minus 2% is 6%. So if it's getting increased above 6%, then RBI has to increase its repo rate to combat the inflation, to decrease the money supply in the economy. So here you see the repo rate is increased here. Again, when this inflation is increased to 7.4%, again this repo rate is increased from 5.4 to 5.9%, and later on from 7.4, you can see here in December 2022, here you can see here the repo rate, this repo rate is increased, but inflation is decreased to this point. Inflation decreased to 5.72, and now repo rate is 6.25. So there is a direct relationship between inflation and repo rate. If RBI increases the repo rate, it will fight inflation, and inflation will be down, as we can see in this graph and in this chart. So here quickly we will see some of the previous year questions which are generally asked on this topic, monetary policy tools and monetary policy. Here with reference to Indian economy, consider the following. This was asked in 2022 and this they were asking the components of monetary policy. Here the 1 and 2. We have already learned bank rate and open market operation, but these two are not the tools. The next one is if RBI decide to adopt an expansionist policy, just now we seen that expansionist policy increase the money supply. Which of the following it will not do? So it is asking not to. So generally in expansionist policy we decrease the uh, statute SLR and we decrease the bank rate, that is the repo rate. So here it is saying that not do. So these two will be wrong. So one, where will 1 and 3? It will be wrong. So only one option is left, that is 2 only. So if we increase the marginal standing facility rate, it will not hamper the expansionist policy. We already learned. The next one is as increase in the bank rate generally indicates that if we increase the bank rate, that is the policy rate. Bank rate is absolute. So this is the repo rate you can refer to as. So if increase in the repo rate generally indicates that bank is having a tight money policy. Very easy. If it is a tight money policy, there will increase. If this is a not tight money policy, it will there will decrease in the bank rate or repo rate. So similarly, on this ground, we can solve many previous year questions which are generally asked to this topic and very helpful. And also in mains, we can support what we did in the previous slide with the graph of repo rate and inflation to supporting our arguments in terms of this question. Do you agree with the view that steady GDP growth and low inflation have left the Indian economy in good shape? So this topic is very important. Always in news that RBI cuts its short basis points, increases its repo rate, decreases its repo rates like that. So it's always important for an UPSC aspirant. It's very important this topic. So I have covered this topic.